Okay, so this will be module two. We'll just jump right into that. So I'm going to focus this one on debt securities, right? And so when we buy debt securities, what we're wanting to get is some sort of fixed income normally, right? So we think about bonds normally with this, and bonds will have a set coupon rate. It can be a zero coupon, but it has some particular interest rate, and then it'll have a maturity date and then a par value that it will mature to. So it's very straightforward and more easy to plan with because of that regular nature, right? And so we're going to talk about default and credit risk on bond pricing. So normally when we've talked about bonds in your previous courses, we just assume that the bond holder is going to receive everything from the issuer of the bond. But now we're going to talk about some risk associated with that. And we're going to talk about collateral credit default swaps or a CDS, and then collateralized debt obligation or a CDO, right? So CDS and CDOs. And then that debt can be a very particular type of debt. So like an MBS is a mortgage-backed security. So we'll talk about those during this module. And then we're going to talk about the term structure of interest rates, because obviously if these are set on like these fixed rates, or it could be a formula saying this international interest rate plus some percentage, then we could, obviously we need to understand the structure of those interest rates. So there's the characteristics of the bond that we're going to talk about. That the par value is what I said that you get upon the maturity. So you pay some market price that it sells for in the market today, and when it matures, you're going to get that par value. And then you would also get the coupon rate, which is whatever they state that the interest payment will be, based on what that par value is. And then an indenture is what they call the contract. You'll hear a different term called debenture. That's a particular type of bond, but a bond indenture is the bond contract. And so that's why like default is a big deal, because they're breaking a contract, right? And so contract law helps us settle those disputes. Okay. When we talk about treasuries, you'll hear T-bills. Those are short term, so it'll be less than a year. T-notes are 1 to 10 years, and then anything more than 10 years are a T-bond. And you can purchase them directly from the U.S. Treasury. Often they're the large purchases are done by investment banks for their clients and for their own portfolios. But there's a very active secondary market as well. As we talk about bonds, understand that bonds could have a call associated with it. This basically would allow the bondholder to call the bond so that they can refinance, right? So if I lock in 6%, and then the Fed drops interest rates and suddenly I could get one at 4%, then I might have the ability to recall my bonds and then reissue them at the lower rate. And so normally there's a fixed period of time, though, like, well, you can't do it for at least 3 years, because the people that buy the bonds, they like to have some sort of stability because they bought the bond for a reason, right? And if it's callable, that's a provision that as a bond holder, you'll be rewarded for as a higher interest rate, right? Convertible bonds, instead of I'm repurchasing the bond with cash, and then I can raise the cash with a new issue. Convertible bonds turn the bonds into shares of stock, basically. And then put bonds would give you the ability to put the bond back. So a put is an option that would cause the other party to buy it from you. And then there are floating rate bonds. These are bonds that will move based upon some benchmark rate. Preferred stock is we often refer to as a hybrid security, and it looks like fixed income because it has this like steady cash flow, right? Um, but it is actually an equity item, right? You don't have the same contract, so if they fail to pay a dividend, you cannot sue them. But they're not able to pay dividends to other shareholders without paying you first, right? That's what makes it preferred stock. So it looks like fixed, but it's in between. It has some properties of a stock, and then some things that look like a bond. As far as international bonds, I'll let you read about some of these differences. Just to understand when you're going into international markets, sometimes it's easier to raise capital in that particular currency. And so it might be better to do a bond issue within that country if the country is able to finance that. So if you're going into a more developed economy where markets are pretty deep, you often can do that. If you're going into a developing economy that is not very large, then you may not be able to raise the money locally anyway, right? And it may be something where you're dealing with like an infrastructure project, and you'll just do it in US dollars because ultimately Chevron is going to be taking the oil or whatever, right? So yeah, it just depends on the market. Like, is it better to issue debt in the US or issue it in a third country, or issue it in the country in which you're making the investment? I'll just you pause and can read over this. I just wanted to mention though the tips there at the bottom. These are U.S. Treasuries that will be modified based on what inflation is, right? So the United States government tracks inflation, and some organizations will have automatic pay raises, right? Or maybe we'll have a contract, and that contract will have an inflation factor built in every year. And we agreed in the contract we're going to use like the CPIU rate or something like that as our baseline. Tips will allow you to buy into a treasury, right? Which treasuries we think of as risk free because the U.S. government has not defaulted on debt. So it's risk free, but it's not real, right? Because real would mean you've already accounted for inflation. So if you want a real risk free, you can buy these tips, and it would give you that because you have protection from inflation because it automatically adjusts the interest rate to match for inflation. And it also is a U.S. Treasury, so you don't have to worry about default. The way we normally calculated bond prices is the present value of all of these future coupon payments from time now until maturity, and then also the par value that we get at maturity discounted back to today. If you did this on the calculator, that's what the calculator was doing for you. The coupon would be the PMT, and the par value was the FV, and the rate was the interest rate per year, IY, and then T is the N. So you would have put that into your calculator, and we can definitely do that as well. But this is all we're saying with the bond value. It's just the present value of the future cash flows. And if you think about that, that's really how we value really everything within a corporation, as what is the present value of all of these future cash flows. This part right here where we're talking about the maturity of the bond, and it having changes the sensitivity. When we talk about that sensitivity, we're going to talk about this later as something known as duration. So understand that the duration of the bond and the maturity of the bond are different. Well, they can be the same, but only for a zero coupon bond. So just understand that those are going to be different things, but they're both are important. And so this shows you how as interest rates go up, the bond prices go down. As interest rates go down, the bond prices go up. And that's because we are discounting back, and we're discounting back with that interest rate. But if you notice, it makes a curve. It's not a straight line. It's not the linear relationship, right? And so as we're going through that, we're going to be concerned with what is the slope at each point, right? We're not going to do the calculus to solve for that in here. We're going to do some algebra instead, and basically estimate how much it is, because we know that interest rates tend to not change a lot. And so if we can get a good estimate nearby, it's probably going to be really close. Yield to maturity is what we normally talk about with bonds. And this assumes that you're holding it until maturity. That's why it's called yield to maturity. And so if you think about that, if we have it not till maturity, but some holding period, that holding period return would be different probably than the yield to maturity. And so we're going to just understand that we're going to initially calculate things based on, things basically going all to plan. And then we're going to see how prices change when underlying things change, such as interest rates, or the bond gets called, or something else would happen. This is just an example. So if you want to practice doing this, it's an 8% coupon bond. It matures in 30 years. They're doing semi-annual payments, and it's currently selling for $1,276.76. And so this is the yield to maturity, is going to be this 6%, because that is what would balance that equation, right? So if you put it in your calculator, then you would say that the N would be 60, because they're semi-annual payments. Your payment is 40, right? Because it's half the coupon every 6 months. The par value is 1,000, and then present value would be 1276.76, and then solve for your IY. Understanding that is for the half year, so you need to make it for a full year. You may hopefully remember current yield. The difference between yield to maturity and current yield is current yield is looking at what's the current price, right? And so yield to maturity is based on, everything's being all your cash flows are coming in. You're able to reinvest all the coupons to get the same yield over time. All of those things. So the current yield is based on where the market is right now. What does this bond yield? And you can see this relationship with premium bonds. The coupon rate is higher than current, is higher than yield to maturity. And for discount bonds, the coupon rate is less than the current yield, is less than yield to maturity. Yield to call. Understand that we're only going to call if rates are going down, right? I don't refinance my home loan or my mortgage, right? When the interest rates go up, I'll refinance when I get a better rate. And so here's what that would look like. So you see, basically, as interest rates go up, there's not much of a difference. But there's a little bit of a risk there, right? And so it is a bit lower. And then as interest rates get really low, it starts to just plateau out, because it's going to get called. They're not going to keep paying 10% if they can, refinance it at 6%, right? So that's what this is showing. And one of the things that we don't really talk about in earlier courses, but it's important to remember now as we're going forward, is, we're assuming that all of these intermediate cash flows you're receiving, you could invest that right back into the market and get the same return that you were getting. And that's a bold assumption, right? Because even though you have this bond and it's paying well, if interest rates have changed, I can't go buy that same bond, right? Because the yields are different and everything. So if I want to go buy new bonds, I'm going to get a different rate. And so that's an issue that people have to contend with, even with what we would consider to be the more straightforward investing of bonds, because people do, pay off their car loan early, and they'll refinance when they can, and those kinds of things, or we'll get the money and then suddenly we don't know what to do with it, right? That we don't have new loans that people need made. And so that's the consideration we have. Regardless of whether the bond is a premium or a discount, they will always converge, to whatever the par value is. So that's just going to remind you of that relationship. And then just pause and read over this, but the difference between yield to maturity and then the holding period return, right? Because the yield to maturity is assumed to be to maturity. And then before we're just taking it as given what the appropriate discount would be. But now we need to talk about all of the other things that can happen with your bond, such as the default, right? And so we have rating agencies that will go and evaluate the particular risk of an issue. And then based on that rating, we either have investment grade or speculative grade, right? And so investment grade, you have a lot more flexibility in investing there. You're not necessarily allowed to invest in speculative grade depending on what the investment profile is. But as you can imagine, the speculative grade bonds are the ones with the much higher returns. Okay. And so this is just to move on, just talking about some ways to look for is this firm more likely to default, right? And it's kind of like the triggers that a credit analysis firm would use. Are you likely to default on your credit card debt or on your car or something like that? And so what this is doing the same type of thing, only instead of looking at an individual's credit, you're looking at a corporation, trying to determine does this company have what it takes to be able to pay this back? And this is, all these different ratios that are easy enough to get, and then based on different weights placed on them, you can come up with a Z-score, and then that will tell you, does this look like they're close to bankruptcy? Does this look like it's generally safe? And then there's a bit of overlap where you're kind of like, this is just sort of put it on the watch list. But this Altman Z-score is just one way of trying to determine sort of what would the credit rating be for the firm. Okay. And so mentioned that the bond indenture is a contract, right? So when we make this issue, it explains exactly how this is going to work, and some things that can be in there, things like a sinking fund, where basically we want to make sure the money is eventually there. And so what happens is we have the firm setting money aside so that they can repurchase these bonds so they don't all hit at 30 years, right? So they'll start buying bits of them early, in the lead up to it, just so that they can sort of spread out that shock, because we're not trying to cause disruptions. They can also have clauses in there where you're not able to take out more debt or limit the amount of debt, again, because we want to make sure we get paid, that kind of thing. And then they could be particular collateral. In fact, that's really common with bonds, where they try to link particular debt with particular assets, just to make things cleaner. So we talked about the yield to maturity being like you assume that you're going to hold this the entire period. And so now we have to understand, well, they could default before it becomes time, right? And so we have this default premium, which is something that we would add to, what the yield to maturity, we expect, or we were promised we need to add to it to say this is what we, are now going to expect in the market. Okay, so we know they can default. So what can you do to protect yourself, right? And so one of the things is a credit default swap. And it really is what it sounds like. In the event that there is some sort of default on this existing credit, I can swap the obligation with another firm. Right. And that's what makes it a credit default swap. So it looks like insurance. It's not insurance. It's not regulated like insurance. Um, but the structure of it, being like this negative event occurs, and so therefore I'm going to be made whole, or at least partially whole, and I'll be indemnified to some extent by this swap. Okay. So basically, this is just a way to make everything more credit worthy. However, we had a lot of issues, particularly in 2008, because one firm in particular, which was AIG, had just a tremendous amount of these swaps outstanding, and they were going to need to pay them all off. Like simultaneously, and when they couldn't, it was going to cause this cascading failure through the system. So that's one of the government had the Troubled Asset Relief Program, the TARP, right? The big too big to fail buyouts and that sort of thing, was because they had all of these credit default swap contracts outstanding. Okay. Now this is a different way of transferring risk. And this is a collateralized debt obligation. And so the idea is I'm going to create a special company, right, that will go out and will buy a bunch of debt, right? And then we will pull those together, right? And then we take the income from it, and we have some group that we know gets paid first, and then other ones get paid second and third, and then we have some that are getting the very last. And the idea being, since we have so much going into this first group, they're always going to get their money. So that's like AAA rated. And then some of these other tranches might fall down to like triple B, right? Still investment grade, but teetering. And then you can have some that are just for speculative grade. And again, depending on what the asset is, will determine actually how valuable that is. As you go through here, we're going to talk about the yield curve. And so the yield curve just shows what is short-term rates and then what are long-term rates, where you expect the short-term to be lower rates and the long-term to be longer rates. And that's what we would call a normal yield curve. It can become inverted. And when that happens, that's normally a sign that we are entering into a recession. And so if you think of some of the conversations that we've had through the year 2022 about, are we in a recession or not in a recession? This is one of those signs that people look at to say, this is a sign that this is occurring, right? And so this is just a few different shapes that you'll see. January 2006, you see there was a flat yield curve. And then like in December 2012, you see how there's a sharply rising yield curve. They started raising long-term rates. Then September 11th of 2000, this is pre 9/11, right? This is right during the dot-com bubble. And you see that's an inverted curve, right? Where it's higher for short term than it is for long term, right? And then you see that in 89, how it was, is what they call hump, right? So it goes up and then comes back down, which is another unusual curve. So the bonds themselves, right, are based on their yields, because the yield curve is going to be like based on treasuries, right? And then corporate bonds would be adding on that. But if you look at a bond, not just as it being a bond, but a series of coupon payments and then one big final payment, and that's where bond stripping and putting those back together would be bond reconstitution. If you strip it out like that, you can calculate what each piece should be worth. And so you can look for some market mispricings and take advantage of that. So again, this is a coupon bond. We've done this example before. And then here's two types of yield curves. It has to do with whether or not we're stripping these bonds. And so it's really has a lot to do with like your data and also how you want to do the processing. It's not that one's better. They're just different. Okay. And so this is an example. You can look at two different ways of investing for 2 years. I can buy a 2-year bond. It's a yield to maturity of 6%, and I just hold it. Or I could invest in a 1-year bond and then know in another year I need to buy another 1-year bond. So I'll buy one bond that lasts 2 years, or I could buy one that lasts 1 year and then I'll buy another for the next year. And so if you look at it, the one right here in the middle where it says 2-year investment, right? I spend $890 and then I get the 1,000 in 2 years, right? Or I get $890 and then it grows at 5%, and then that's worth something. It would be reinvested, and then it's going to grow to some amount. And so I can calculate what this interest rate is implied to be, because I know what this 1 year is and I know what the 2 year is, because I've got that yield curve that gives me those. Right. So we're gonna come into this later, but that's what a forward rate is. It's what the interest rate is assumed to be by the market, right? That's the price the market is putting on it. I don't know what interest rates are actually going to be in a year, right? There's no way for me to know what they're going to be. They'll be whatever the market sets it at. But I know that as of today, the market is behaving as if it's going to be this amount in a year. Excuse me. These are just some definitions for spot rate and short rate. Again, we talked about holding period returns on the bond. So when we are looking at our bonds, again, we assume that type of convergence, right? They should look the same, but we know that we have uncertainty in our world, right? And so this is to look at what the short rate versus the spot prices. So if I could buy a 4-year investment, I can get what it would look like, a 3-year, a 2-year, and a 1 year. But then if I'm looking at in 1 year, what is the 1 year rate going to be? Well, 1 plus 5% times 1 plus this implied percent is going to be 1 plus the 6% squared, right? And then the same thing, once I know what that looks like between, year 2 and year 3, year 3 and year 4, right? And I can calculate each of those, and we call that bootstrapping. So these are those forward rates. I was saying it's 1 plus these rates, right? That's where all this is coming from. In our example, we had each year, but if you were missing some years, then you could use that to skip over it. But yeah, so that's how we will bootstrap those forward rates. That's just to give you an example. The nomenclature that you see here, this tells you the year, right? And then this F sub 4 is the forward rate at time 4. You'll often see it written as well, like 1F4, and it's the 1-year rate at year 4. But in this one, we're just doing it this way for now. Because we don't know what's going to happen with these interest rates, right? That will also be another premium that we add on. So you're going to start seeing where we actually end up with a series of premiums that are that go into what this overall discount rate is, and those can change, over the year. So the required discount rate will change on a variety of factors. This is a couple of theories on why the term structure looks the way it does. The expectations hypothesis, is basically what most people sort of think about, with it saying, we just generally expect interest rates to look this way, right? And so, like, it's just most parsimonious, right? Expectation is a slight growth in the market, interest rates going up, but we do know that there's other issues in play, and so liquidity premium and which one of these holds will change based on the type of market that we're in as well. And these are just, again, some different yield curves, and then how different premiums show up. Okay, and we talked about term structure. And so just understand that it tells us a lot of things, because what we see is the resultant yield curve, and we know parts of those will be some of these factors like liquidity. So just as you're looking over term structure, those are the things to consider. But yeah, so we generally expect it to be shorter rates, lower than the long-term rates, and seeing that makes us think of just general expansion. If the yield curve is the opposite, we would call that an inverted yield curve, and that's normally a sign that we're entering a recession, or may even be in a recession. So we talked about forward rates, right, and how we can bootstrap what those are. We can also have forward contracts where we can make an agreement to get that at some point in the future. So this is a way we'll talk about engineering. If you ever hear financial engineering, that's what we're doing here. So we want to get this forward rate of 7.01%. And so what we could do is take, instead of a 2-year rate, we have a 1-year rate, and then lock in what the forward rate for time 2 would be, and then have that contract. All right. Well, module 1 and 2 will have an exam. So just email me if you have any questions on this material so far.